This is Jay Martin.
Here I am with Grant Williams. Grant, it's great to have you back on the podcast. I'm looking forward to chatting with you today.
Hey, my friend. Always good to see you, Jay.
So here's where I want to start. I have a handful of directions I want to go with you today. I want to talk about sort of the transition of currencies that we're witnessing today. You covered this a lot in your letter. But I want to give the first couple of questions to our Commodity University members. They're big fans of yours. So we meet up monthly, share ideas, investing in the mining sector. If anybody's looking for that advantage, check out thecommodityuniversity.com. But they were pumped you're coming on the podcast today and had a few questions. So I want to start with their questions. And the first was on the silver sector, because we saw some real activity last week in the silver market. You know, a 10% drop in like mere minutes, right? And so first question, Grant, is when you see activity like that, does it represent anything real in the silver market from a supply and demand standpoint, real fear in the sector? Or when you see a move like that, are you just like, clearly that is some traders getting caught with too much leverage who just got margin called? How do you differentiate?
Well, there's a couple of things I'd say, Jay, and that is, one, let's first of all remember that it's silver we're talking about here, and we'll come back to why that's important in a second. But the more important thing I think is to understand the context of that move. You know, if the silver price has been going sideways for 6 months and then you get a move like that, that's a big deal, and that should wake anybody up and have them asking questions. But the reality is, given what silver has done, Steph and I recorded a podcast a couple of days before that. In fact, I think the day before that. And we both said, we both know there's a big correction coming in this thing because it's just run so far, so hard. It was really inevitable that was going to happen. What's important really is what happens after that. And I think anyone that's been watching precious metals markets for some time now, will recognize the patterns that we tend to get these smash downs in the thin trading hours, overnight, New York, COMEX. And it's always a question of what happens the next day when the regular participants are back in the market. Does it bounce? Does it get sold off even further? Does it kind of stay down where it's been smashed to? And, for the longest time, you get these long periods where you'll get the overnight smash and it won't bounce back. And after a move like silver's had in recent weeks, it wouldn't have been surprising to see it smashed and stay down. Mm-hmm. But it didn't. It rallied straight back in. I think that's important. The fact that the smash didn't actually stick. It's funny, as we're sitting now, I've got the price on my screen. And I can see silver's just dropped about 75 cents while we're chatting, pretty much in a straight line. But again, this is the nature of the beast. And I think if you're involved in the silver market and you're not prepared for stomach churning volatility, then you don't really know the animal whose back you've jumped onto, because it's just that kind of thing. We happen to have had a period of several weeks, a couple of months even, where it's gone up in a straight line. And of course, everyone gets giddy when that happens. And then the fear returns as soon as you get a down day. But if I showed you a chart of silver, you didn't know what it was, you weren't invested in it, and you looked at what we saw last week in terms of the correction, you'd think it was perfectly normal. And I think it is. I think silver and gold go much, much higher. They are guaranteed to not do it in a straight line. Mm-hmm. Guaranteed. And I think the places they're going to will make people's eyes water. But they're not going to go there in one go. And we are going to see big drawdowns. We're going to see every kind of attempt by both of them to throw you off the horse. And again, you and I have spoken about this before, but I think it's a really important thing for people to understand, and that is to have a gut check and understand exactly why you're in this thing, and perhaps more importantly, your kind of character, your nature. I framed it before saying, are you an investor or a speculator? And there's nothing wrong with either. But if you're an investor in silver, then you shouldn't have become too excited on the way up, and you shouldn't have become too phased by the drawdown. If you're a trader, then you're either going to be rubbing your hands at this kind of volatility, or you're going to be the kind of trader who gets swung around by it, and it's going to be a really, really tricky period to negotiate. So the first thing people need to do, talking about the Commodity University guys here, is take a long, hard look in the mirror and really think about who you are. Are you someone with a high tolerance for risk? Are you someone who believes in the long-term story of precious metals and wants to own them? Or do you see an opportunity here to make some fantastic trading profits? Because your mindset is going to be completely different depending on which one of those ways you lean towards.
There's a handful of threads in there that I want to pull on, but actually I want to start with the very last thing that you said. And the question I want to ask, Grant, is in all honesty, because you said this, and I think about it a lot. Are you an investor or a trader? Are you investing in businesses or are you trading share prices? And a lot of people think they're investing, but they're really trading share prices, and they're very different things. You said if you're a trader, you might be rubbing your hands together at this opportunity. But if I were to ask you, how much time does it really take somebody to become competitive as a trader? Like, if someone's asking themselves that question, they're looking in the mirror and they're saying, what kind of capital allocator am I? Well, I'm an investor, and I'm a long-term value investor as a consequence of how much time I have to invest in my portfolio, right? If someone thinks they're going to be a trader, what's the honest answer to how much time you'll have to invest in that activity to actually be competitive?
Well, look, it varies, but you have to understand a few things. First of all, if you are new to this game and you want to be a trader, you have to recognize that everybody else has a head start on you. If this is your first time trying to do this, everyone has a head start. And having a head start as a trader, not in terms of prices, people tend to focus on the prices and focus on the numbers. The reality is you need to focus on the emotional side of it, because all the good traders I know, and I've been fortunate enough to work with some extraordinary traders over the years, it's always the mental/emotional side that sets them apart from people who tend to lose money trading. And it's their ability to remain clear and remain focused when markets are moving, both against them and in the right direction, because either way you have decisions to make. And this is it's a decision-making enterprise. And depending on your time frame, you have multiple decisions to make every day in some cases. And for guys like you and I who have the luxury of a low time preference, we might, I made a decision on gold in 2003, and I've stuck with that decision ever since. I've bought more along the way, but it's never gotten to the point relative to other assets where I want to exchange it. So I haven't had to make those decisions. I've watched it go up to 1900 in 2011 and get cut in half again. I've watched it do what it's done in the last a couple of months and over the last several years, and it hasn't given me any decisions to make because I'm set. I know what my targets are, not price targets. I don't have price targets. It's a relative game for me. But if you are trying to trade, first of all, don't start with gold and silver. Whatever you do, don't start with gold and silver. Start with S&P, the SPY ETF, or something that is not as volatile and gives you the ability to look at something that's very broadly held, is not subject to people coming in and smashing things down like we see in the futures markets overnight for gold and silver. And you can start to learn patterns and start to learn trends and start to learn how things move and what is it that makes them move. The commodities markets are not the place for fledgling traders unless you keep very tight stops, and you should expect, if you do so, that you're going to get stopped out a lot. And as long as you learn when you lose money, as long as you understand why you lost money, that's okay. As long as you're smart with your risk management and you don't lose more than you can afford to lose, et cetera, et cetera. These are all very basic ideas, but they bear repeating. Making the same mistake twice is forgivable, but it's not ideal. Making the same mistake 3 times is the time where you might start to question whether you're in the right game. So, the other thing I would say that's useful advice that someone gave to me many, many years ago is, if you make money, you need to understand why you made money, because it's very easy to have a thesis, to put it into play and make money on it for all the wrong reasons. And we never tend to have post-mortems if we make money. We tend to assume it's our brilliance and we got everything right. And many times you'll be right for the wrong reasons. And it's important to have the confidence and the honesty to look in the mirror and say, actually, I got lucky there. Yes, I did make money. I was long, but it wasn't because of the reasons I thought. This happened or that happened, and that's why I made money. So I need to factor that in when I'm rethinking this particular trade the next time I might want to invest in that particular commodity stock index or whatever.
That's so important what you just said. And when you build a position, having some kind of documentation explaining it to yourself, the rationale for the purchase, the catalyst you're looking for, all this stuff, because that document provides you a piece of evidence in the future that you can use to keep yourself honest. Because inevitably, if you achieve a capital gain, it turns out you're right, your conviction and your decision in hindsight goes up. Like, I knew this was a smart decision. Yeah. I knew it. I could see it all and I should have gone bigger, right? But when something goes south on you, you look back on that same decision and you're like, I knew it was a high risk bet. I knew I shouldn't have done it. I knew it the whole time. I shouldn't have done this, right? And that's hindsight bias, and it's very real, and it affects all of us. But if you have
Jay, there's a great story about this. I've told this story many times, and if anyone's heard it before and is bored, I totally understand. But it bears repeating again for people that haven't heard it, and that's the story about Stan Druckenmiller being interviewed by Ken Langone live on stage. And Druckenmiller famously, while he was working for the Quantum Fund for Soros during the dot-com bubble, he'd been shouting from the rooftops that it was a bubble and things were getting stupid and he didn't want to have any part of it. And he was sitting next to the two young guys who were running basically the dot-com portfolio at Soros. And, Stan eventually couldn't stand it anymore, watching these guys making money every day. And he jumped in and he lost $1 billion of Soros's money. And Ken Langone said to me, what did you learn from that experience? And his answer is so brilliant and people need to really absorb it. He said, I didn't learn anything. I knew I shouldn't have done it. I just couldn't help myself. If Stan Druckenmiller can be, affected by FOMO, then none of us is immune. And so just learning that lesson and having the guts to stick to your principles, stick to your kind of predetermined idea about how you're going to do something, and not get swept up if it's going the other way or if someone else is making money. That's a total irrelevance. And I know it's difficult. It's part of human nature to be envious of people who are making money, and seemingly, we saw this in the crypto phase. People are making money just getting up in the morning, and it sucked a lot of money in. But if you're going to be a trader, you need to have the discipline to not only let other people make money and you sit this stuff out, but also leave money on the table. Don't look to top tick and bottom tick everything, because that's those last 10%, 20% of every move at both ends. That's where the damage gets done. Because if you, and Stan said this as well, you make your money in the belly of the move. You leave the first 20% until you confirm the trends in motion. You leave the last 20% to someone else. You take the two volatile points of the move out of the way, and you just make decent money without having to extract every last dime out of everything.
Right. Yeah. Which is, you're right, very hard to do. I love that Druckenmiller parallel, right? Because you're like, you think you're emotionally durable enough? Okay. So 2 more questions on the silver market based on what you shared earlier. You did this podcast with Steph right before this move in the silver sector. So you've seen the year that silver's had, I think it's tripled in price. What's your take? Do you have a perspective on what's driving that today between industrial demand or monetary speculation? One of the two, Grant. Which do you think's in the front seat right now?
I think, as always with silver, there are a number of factors at play. I'm encouraged because I think a lot of it is supply and demand, which is great. That's what you want. You want a commodity that is moving for supply and demand reasons, because it's much easier to figure those out, and it's much easier to take a position because you can watch and wait for that imbalance to start unwinding. I think silver is also a beneficiary of gold becoming too expensive for a lot of people. So I think gold has reached the point where people who want to own gold literally can't afford it. In places like India, they can't afford a gram of gold, so they're switching to silver. We've seen a massive uptick of money coming into silver from India. You've got the future set up. You've got all the wonderful conspiracy theories. If anyone's new to the silver market, I would encourage you to go down the rabbit hole, but tie a rope to a tree, so you can only go down so far, because it's a wonderful place filled with some extraordinary conspiracies. But it's just an incredibly volatile, speculative asset that just happens to have a really solid level of industrial demand, which is why when it gets going, it pulls in all kinds of different people. And, as I say, the big encouragement for me in this move is the supply and demand component of it. And, my friend Ned Naylor Leyland, who runs a precious metals fund, I won't say the name because I know whenever we talk, he can't, so I don't want to drop him in it. But if you Google Ned, you'll find him. He's been at this for a long, long time, and he's incredibly bullish about the setup here. And I don't want to put words in his mouth, but when we've talked privately, he's very encouraged by what he's seeing, and the fact that he's yet to see the kind of things you see in terms of crazy phone calls and crazy demand that you see at the end of these moves. He's yet to see that. So with silver doing what it's doing, it's really encouraging that the kind of the money that we normally see pile at the end doesn't seem to be there yet, which is great.
And I agree with that. I'm in a handful of just like groups with entrepreneurs who have made a bit of dough and they invest in the market. They're generalists, and it's incredibly infrequent that I see anybody who's even got an interest in precious metals from the generalist investor market. They're still betting it all on AI or just the broad equities market, because as if there's, that's the obvious choice that anybody would make, right? Yep. They're not even looking at precious metals yet. Okay, now sticking with silver, but switching to geopolitics. Tomorrow, January 1st, this export ban restriction from China comes into play on the silver market, which is kind of reminiscent of, China was the place where silver went to die back in the 19th century, the triangular trade between the tea, silver, and opium, which, interesting stories there. But here we are again. China is banning the export of silver, any metals that have dual use, civilian and military, which gives them discretion on who they're going to sell to effectively and gives them an easy way to say no to silver export. Is that how you read it, Grant? What do you make of a policy like that? What's it really mean?
Well, look, to me, and people will disagree with this, to me, it's a political move. And because it's a political move, that means it will be changed for political reasons, not for supply and demand reasons. And so whilst it's definitely a short-term boost for the price, because people are going to be speculating about what it means, any move that's made for political reasons like this can just as easily be undone. We've seen this with the tariffs. If anyone hasn't figured this out now, watching the tariff back and forth over the last couple of years, then they haven't been paying attention. So, whilst I understand the effect it's had on the price, and it's definitely something you have to keep a close eye on, but I think the fact that this is coming in on January the 1st, to me, there's no guarantee it doesn't get rescinded on January the 4th when a few phone calls get made. So it's not, it's bullish for the price. I don't know how sticky it's going to be. So it's certainly not something that I would say, right, because of that, I'm going all in on silver, because this means for the long term, a massive shortage of supply. I just get very nervous about trading politics with metals. Expressing a view on a political situation through metals is not always a sensible way to do it, I don't think.
Yeah. Okay. That makes sense. And that's kind of been the status quo, right, with this trade war. It's like a lot of head fakes, a lot of announcements, very little substance in most of what we've seen from a headline standpoint, which is great for rallying political sentiment, I guess. Look, we're doing the things that we said we were going to do, but actually what's stuck to the ground hasn't seemed to be much at all. Okay, I want to maybe just dip into the U.S.-China trade war a little bit as we move towards currency wars. I want to talk about that with you today. You covered an amazing parallel in your recent letter, which I want to talk about, the sterling to the dollar transition and what we can learn from that and use that as a filter for current events. How do you read and how do you determine noise from signal when you see the rhetoric flying back and forth between President Trump and President Xi? What do you pay attention to? What do you ignore? Do you have any principles you can share, Grant?
Yeah, look, I think you have to pay attention to all of it because in amongst it, there are things that are going to matter. But I think the important thing to understand with anything that's overtly political, like all this stuff is it's subject to change overnight. And there really are no hard and fast, unless we get something like a renewed Plaza Accord like we saw back in the late 1980s. Something that's concrete and has signatories and all the kind of things you get when a lot of central banks come together to try and avoid a problem. But political posturing and threats and all this kind of stuff, you have to be aware of it because it will move the price. But a lot of the time, it doesn't necessarily have a long-term effect because these things get reversed as soon as they become inconvenient or the wrong people decline to get involved. It's very dangerous to trade headlines because in this day and age, we don't get a headline every day. We get a headline every 20 minutes. Mm-hmm. And so, again, coming back to your competence as a trader, if you are a really good trader and you know the skills involved in doing that, and I'll come on to one of those specifically in a second, then it's fine. But if you're learning to trade, it's very easy to see a headline and think, oh, this means X for the price, and pile in as if that's going to continue into the future, and it's not necessarily. And a really good friend of mine, Lee Robinson, who's a terrific money manager. I remember interviewing him years ago for Real Vision, 10 plus years ago. And I asked him, I said, what's the difference between professional investors and retail investors? If you had to boil it down to one thing, what would that be? And he didn't even hesitate. He said professional investors know how to sell. Mm. And it's such a simple phrase, it's such a simple idea, but there's a lot of really, really powerful truth in that because pros do know how to sell. They do know when to, as I said earlier, leave money on the table. They do know when an idea's gone wrong and no matter what the P&L is, I need to cut this. They do know when, a headline gets reversed, it's time to get out. And knowing how to sell, because when is part of the how, is a terrific skill to try and teach yourself. And part of learning how to sell is understanding the kind of whipsaw nature of some of the things that you can trade for a short-term move and not getting wedded to them. And a lot of these headlines that we're talking about here are definitely very well in the center of that kind of category to me.
I love that. Yeah. And it comes back to what you shared earlier about having a documented rationale for buying anything in the market, because it allows you to reflect on that. If the price corrects 30% after you purchased it, you can look back on your rationale and say, well, I bought for these reasons. Those reasons still stand. And in my document, my time horizon is 3 years. We're only 6 months in. So should I be sweating 6 months of volatility? But the same thing to the upside, right? We've seen a lot of mining equity prices really skyrocket. And again, I'm in a handful of chat groups with other investors and I'm seeing people celebrate 200, 300% returns, slapping high fives, really happy. But the pros I know, the Rick Rules of the sector are taking cash off the table, right? Doesn't mean they're selling everything. It just means an opportunity has arrived to regain your principal, to take it, right? And get that free ride. If the market gives you that gift, take it. And it feels like selling too early because maybe you've waited 10 years for this precious metals rally and now it's here and I'm supposed to sell. Like that sounds crazy. But exactly what you said. I think the pros buy similar to most people, but they sell much better. And that's the difference, right?
Yeah,
and
absolutely.
That's how you stay at the table, right? And duration is what wins.
Yeah, no one ever got poor taking a profit.
There it is. So is there a parallel here? Getting back to US-China trade war, I'm thinking like, I'm a long-term investor, but I have to deal with short-term volatility that sometimes is created by traders getting in, overbuying, overselling, overbuying, overselling. But if I step back and say, I just have to wait this out for my long-term thesis to play, I'll be okay. And there's a similar game being played between an Eastern economy that doesn't have to worry about election cycles or public sentiment. They can play a long game, a decades-long game. And China's a country that plans in 10-year cycles. They announce a 5-year plan every 5 years, where there's a subsequent one in pencil at the same time, right? And they've done these 5-year plans since 1952, I believe, right? A very long-term thinking economy. And your competitor has to think in 2-year election cycles because, the primaries and the midterms, the federal and the midterms happen every 2 years. So it's a bit of a similar parallel. Hey, I'm playing this long game, but I'm going to have to put up with some short-term volatility in the meantime. Do you see it that way?
Very much so. Yeah, very much so. And obviously the political cycle is getting shorter and choppier in the West because the West is under significant pressure now. The debt load is reaching the point where it matters in the short term more. Governments are becoming more and more desperate in terms of the things that they feel they need to do to keep the wheels on. And so that those cycles get shorter and choppier and more violent, and it just makes it that much harder to stay in the game and to stay sane and to stick to your the things we've talked about to stay the course. So as you pointed out quite rightly, Jay, in the East they don't have these kind of problems. Certainly not in China. They do in other places, but China is by the most important place for what we're talking about in terms of countries. So I think we're seeing that. We're seeing the representation of this long-term structural understanding in the East of what precious metals are for, a means of wealth preservation, a means of purchasing power protection, all these things that they haven't been in the West for 50 years. So that's a hard habit to break. Whereas precious metals have been money in places like China and India and Indonesia and Vietnam and Cambodia and all these places forever. So there isn't anybody in those parts of the world that doesn't have relatives that owns gold coins and saves in gold and has explained to them why you save in gold coins. So it's not a big leap for them if they see things happening in terms of inflation or rising likelihood that the government is going to have to take kind of extreme action to stabilize a currency or whatever. It's no great leap for these people to turn to gold and silver. It's a huge leap in the West because we haven't done it for 50 plus years. So I think that's a big distinction alongside the political distinctions that you made there that people need to be cognizant of and pay attention to.
So in your recent letter, Grant, you wrote about how no reserve currency lasts forever and everyone will eventually cease to cede to something else. And also you wrote about how people often expect those transitions to come with like a cataclysmic crash of something and a parabolic rise of something else. And it's this big event that happens all at once. And it's obvious to us what's happening, but in reality, it never happens that way. And historically, it hasn't. And you told the story of the transition from the pound sterling to the dollar and the Suez Canal crisis in 1956 as one of those events that happened kind of beneath the surface, but told the world's central bankers a lot about where they should put their confidence. And then you use that as a bit of a filter to address today's environment. Could you share that story here on the pod? And then I want to dig into it a little bit.
Sure. Yeah. I mean, it's tough for people who don't know these stories to imagine, but the pound was once the reserve currency in the world, the little British pound, and the dollar was an also ran. And after World War II, with Bretton Woods in place, it wasn't that even though the dollar was placed at the center of the financial system with its peg to gold and everything floated around that, it wasn't the dominant hegemonic reserve currency that it is today. Bretton Woods was 1944-45. And 12 years later, 1956, the British pound was still by far the most used transactional currency and reserve currency in the world, although there was a significantly higher amount of gold held by central banks back then because we were on a quasi-gold standard. We'd seen post Bretton Woods, we'd seen the dollar pick up market share, but not to the point where it was meaningfully out in front. In fact, it was secondary to sterling in terms of its ownership among central banks. But sterling was getting weaker. The country's political situation was getting shakier. Its finances were getting shakier because, like all reserve currencies, Britain had extended itself a little bit too far. But the important thing to understand there in terms of how it relates to today is that a political opportunity arose. The Egyptians nationalized the Suez Canal, and Britain and France essentially sent the troops in to try and reclaim this. It wasn't as simple as they had thought because chiseling away was their military might as well. Being chiseled away was their military might as well. And the United States found itself in a position where Britain needed financial backing for this. And the United States, which has had and remains apparently in possession of this special relationship between the two countries, put strings on the money it was willing to lend Britain to essentially bail itself out from bankruptcy after this misadventure in the Middle East. And the fact that America was going to extend loans to Britain on terms really was the emperor's clothes moment, where everybody realized that the Brits weren't as powerful as they once had been, and that meant sterling wasn't as powerful as it once was, and it meant that the Americans had the upper hand politically, but mostly because of the weakness of Great Britain in terms of its finances. And America stepped on Britain's neck and did exactly what they needed to do in their own self-interest, and that was really the beginning of the dollar's rise to prominence and hegemony. It wasn't the Bretton Woods system. And so if you fast forward to today and you look at where the United States is, it took 191 years. America first issued debt in 1790, and it wasn't until 1981 that they crossed $1 trillion of debt. So it took 191 years to amass $1 trillion of debt. Here we are 40 years later, and we have $38 trillion of debt. And so, America is in a far weaker position in terms of its finances than it has been at any point during its hegemony. And that hasn't really mattered because there hasn't been a viable alternative in place. The people thought the euro might be it, but there's too many self-interested parties involved in that to make it really viable. It was never going to be the pound again. It's not going to be the yen, the Swiss franc, Canadian dollar, Australian dollar, all too small. So the dollar's had this place at the head of the table that no one's been able to kind of shove them aside from, and until China. And it's not that China has a currency that can replace the dollar, which is, I think, the mistake people tend to make. It's that America has overstepped its mark in terms of forcing sanctions upon people through the dollar system, in terms of confiscating central bank reserve assets of the Russians through their place as the global hegemon. And that's led to other central banks, other countries realizing that, we need to have a plan B here, because the US, while they may be our allies right now, we don't know how long that's going to last. We don't know what decisions we might have to make that might put us at odds with them. And so we need to find an alternative that will at least give us flexibility and won't leave us hostage to decisions made by the US Treasury in terms of how we make payments, how we pay for our energy imports, for example. And so that's a big part of the rise in gold. If you look at the chart, the real rise in gold began right after the Americans froze those Russian central bank assets, because central banks realized that we need to own more gold and fewer treasuries. It just makes perfect sense. We don't have to sell our treasuries, because thankfully the Americans have issued so much at the front end of the curve that everybody's durations got shortened, so we can just let them roll off, and instead of buying more treasuries, we'll just buy gold. And we've seen that happen to an enormous extent. And that aside, we now need to think about having an alternative in case we are shut out of the SWIFT system, in case we are in case we do have our feet held to the fire by the Americans. And the Chinese have very quietly, but in plain sight, been building an alternate system, not to compete with the dollar, not to say the yuan is going to replace the dollar as the world's reserve currency, but do we have a way of paying primarily for energy in our own currency? Can we buy oil from the Saudis into China, who are now the world's biggest importer of energy, and not have to do it through the dollar, not have to convert yuan into dollars, give the Saudis the dollars, which they then recycle into treasuries? Well, until now, we haven't really had the ability to do that. We've been building it. They've had all kinds of test drives. This goes back 15 years. If you go back, and I've chronicled this, Luke Gromman has chronicled this. I came to this, I joined a lot of these dots thanks to Luke's brilliant work. They've been building this in plain sight for some time now. And the dynamics have changed, because with the US becoming energy independent, becoming a net exporter of oil, suddenly the security guarantee that the US gave to the Saudis for on the back of the Petrodollar agreement, it's not as important anymore, because their biggest customer is China by far. In fact, America's not just no longer a customer, they're actually a competitor as an oil exporter now. And so, of course, it makes perfect sense. If you were thinking of this in business terms instead of political terms, of course, Saudi Arabia would want to give the Chinese the ability to pay for oil in their own currency. And that's what's happening. And so every barrel of oil at $65 that gets paid for in yuan is $65 less dollar proceeds that's going to get recycled into treasuries at the point in time where the US has never had a greater need to find buyers for its debt. So the reason I used the Suez example was to point out that we are at a moment in time where, in terms of its finances, America is not as strong as it has been. Militarily, you could argue it's still the biggest superpower, certainly in terms of the amount spent on defense. But there are chinks in the armor now. There are weaknesses, and they are, as they always are at the end of any kind of empire, they are financial in nature because the United States has extended itself so far. And, it's not that China are going to do something to crush them, but they're quietly building the means to go around the US. And just like Suez, the relationship between Britain and America was incredibly cordial and very friendly and very collaborative. We know that isn't the case between the US and China. And if the moment arrives where the Chinese are presented with the kind of opportunity that the US were presented with in 1956, there's no way they don't take it. And so when we get to this discussion about the reserve currency, about the dollar's place in the global pecking order, people are very absolutist about it. They're either the dollar's finished, it's going away tomorrow, or the dollar will never be surpassed. And as always, the answer is somewhere in between those. But the direction of travel has been clear for some time now, that the block that wants to trade outside the dollar is getting bigger. They are building the infrastructure they need to be able to do that. And it doesn't mean a switch is getting flicked tomorrow, but it means that you have to be aware when an opportunity might present itself that that opportunity will be taken with great gusto, I'm sure.
So, what's interesting about this is it really sort of magnifies the importance of access to debt during these late stage years of empire, right? I mean, the Suez Canal was like a key trading route between Europe and Asia. And that was the geopolitical importance. So when Egypt made this move to nationalize, it was a threat to Britain, who had historically controlled that canal along with a few other European economies. And when they responded with military action, they made the assumption that should they need capital, they'd be able to get it from the Americans. And because, even though their economy was in rough shape, they were over in debt, post-World War II, history is precedent, and precedent said the sterling was still a decent bet. So a lot of the world still hung on to it at this point, right? Up into the 50s. It was like 50% of reserve currencies because people assumed, the house is still in good shape. But when push came to shove and they found themselves in a hot conflict again in the Suez Canal, and wars are expensive, and when the Suez shut down during this conflict, oil became a lot more expensive. And suddenly they didn't have the capital to sustain. And they had to go to the Americans for a loan. Maybe they made the assumption, we'll definitely get it. We're Britain, it'll be fine. And the foot on the neck, as you put it, USA to Britain was, we'll provide the capital through the IMF, but you're pulling out of this conflict right away. So the capital came with new conditions, which told the world, you're no longer the one in charge, right? Somebody else is signing your checks. There's a new boss in town, and we just saw the evidence. And that was the break in confidence in the sterling that happened beneath the surface. And you can see it, as you showed in your letter, the increasing percentage of US dollar reserves right after that point, right? When the world said, this is a house of cards, and you can't actually do anything on your own without permission from an adult, in this case being America. And that's maybe where we're getting to with different dynamics today, but that's kind of where we're at, right? And that was the parallel. And so, is it the same access to debt, right? That was what the petrodollar world provided, was America would buy Saudis oil and the Saudis would reinvest that capital in US treasuries.
Right.
But as you put it, that two-way trade is now a one-way trade because US isn't buying the oil, but they still need the treasury money. but the agreement's not there anymore. And so where's that money going to come from? Is that a sufficient summary, Grant? And that's how I understood the petrodollar significance, as you explained it, is it's that dynamic. Out of all the companies, all the countries that are selling product to US, getting cash and reinvesting in treasuries, it's the energy market that was the most important. And that energy trade is now a thing of the past. And the biggest customers of Saudi are now Asia, China, the rest of Asia, and to a lesser degree Europe, but no longer America.
Yeah, I mean, look, you've summarized it beautifully. I mean, the beauty of the petrodollar agreement was that by getting the Saudis and by extension OPEC, as that came together, to price oil exclusively in US dollars, you essentially created demand for dollars with every country in the world, because energy is the most vital component of every economy on the planet. And everybody is either an oil exporter or an oil importer, one of the two. So if you're an oil importer, you need to hold dollars to pay for your oil, because that's the only currency you can pay for it. And if you're an exporter, you're getting paid in dollars. So you've got to recycle those dollars into treasuries. I mean, it was a beautiful construct, and it worked really, really well for 50 years. But it was what provided the US with the ability to run these massive deficits and continually fund this thing, because there was a essentially bottomless demand for treasuries through the recycling of dollars through the petrodollar agreement. Now, as you say, that's changed. The US is an exporter of oil. The Saudis' biggest client is to their east, not to their west, and it's the same for everybody. Everybody's major client now is not America, and so it's perfectly reasonable, and nobody could say that what these countries are trying to do is unreasonable. We don't want to have to pay for our oil in dollars. There's no reason they should. But America understands that that's the chokehold they have over the world, and so they're going to defend this. And that's what they've been using the SWIFT system for. That's where the political pressure has come. But like I said, the Chinese are not doing this quietly. They're not doing it in the shadows. They're building these payment rails. They're building these settlement rails in plain sight and doing these little test trades in them. And people will see that they traded $1 billion of oil with Iran back in 2013 and go, it's $1 billion of oil. It doesn't make any difference. Yeah, it does, because it just goes to prove that this works. And actually over time, the interest comes in, the trade comes in, the volume comes in. We've seen it with the Shanghai Gold Exchange. Another idea, another initiative by the Chinese that was laughed at back in 2013, I think it was, when it first started trading, and now it's arguably the most important gold exchange in the world. The direction of travel is clear, and you can have a view on whether you think the dollar will be the global reserve currency in perpetuity. You can have a view that it might be the global transactional currency in perpetuity. That's totally fine. But you have other possibilities now that are worthy of being entertained. And if any of them collide with a political opportunity like we saw in Suez in 1956, I promise you the Chinese will not hesitate for 1 second to exploit an opportunity to their own advantage. And that advantage will more than likely and almost certainly come at the expense of America's place in the global pecking order. And with that massive debt load that America has, it's weak in the same way that Britain was in the 1950s when they needed to fund that debt. They're subject to the largesse of people willing to do it at lower and lower interest rates. And if the rate goes up, all you've got left is what we've seen the Americans do, which is print the money to buy the debt. And you and I both know the road that leads to, and that's hyperinflation. But to be clear, I'm not saying America's headed for hyperinflation, but that's your option. If you can't find buyers for your debt, you're going to buy it yourself. We've seen this happen over the last 15 years. It hasn't had too many deleterious effects yet, but that's because everyone's been doing it at the same time. So, the world's a very complex place. There are lessons aplenty in the history books, and I think political, geopolitical, and monetary history are very, very important to understand, because no matter what the politics are, ultimately it always comes down to the money. And so the sooner people understand that, the better. If you want to understand the political motives, you need to understand the financial ramifications for those moves, because even if governments, politicians, presidents, prime ministers make decisions that you wouldn't expect them to do if you look at the finances of the country, they will be reversed by the finances. Go back to the British pound sacking that Soros made a fortune of back in the early 90s when we left the exchange rate mechanism in Europe. Look at there are other great examples. I just have one in my head which is now completely gone. It'll come back to me in a second. But there are these moments in time where currencies get turned around. Look at Liz Truss. Liz Truss, that was the one. Her budget, bond market scared her off. Look at the Australian government pegging the yield of the 2-year note a few years ago. The market took care of that pretty quickly and forced them out of that trade. Financial repression tends to not work. It works at the short term, but it's a sign of massive weakness. So the finance angle of all this is the most important angle to understand, and a lot of people don't realize that. They think that politics trumps it, and it might do in the short term, no pun intended, but in the long term it never does.
Yeah. And what I want people to take from this is that the job isn't to predict what the next Suez Canal conflict might be. That's not it. It's to recognize that there was already shaky infrastructure in play. It was like the guy who's living the super luxurious lifestyle on credit cards. And eventually the bank says, no, that's it. You're done. And the Ferrari breaks down and that's it. Game over, right? And this is effectively what happened. Access to debt ran out. And that's what broke the sterling in 1956. And what you're saying is that there's a similar setup right now with the dollar. And, we're seeing an over-levered economy. We all know this. But then there was a couple of events that occurred, one being the confiscation of Russian assets, which sent a message to the world that said, you used to think investing in US Treasuries was the safest bet in town. Well, it might not be. And maybe there's circumstances where we could confiscate that asset from you. And that's a new reality. To your comment about a direction of travel, I love that, because we tend to look at things as they occur and say, oh, this happened, right? China bought $1 billion of oil from Iran in 2013. That's a thing that happened. No. That's new precedent and part of a trajectory. That's the direction of travel. And the confiscation of Russian assets is exactly the same. That wasn't a thing that happened. It was new precedent, right? And that's a better way to think about it.
Yep.
So if countries are a little bit less certain that they want to finance the treasury market, and the petrodollar trade is no longer in play to finance the treasury market, it gets back to this question of what's the access to debt look like for the U.S. economy today, right? Because that was the straw that broke the camel's back of the sterling, the pound sterling in 56. So what's that look like today? And my question for you, Grant, is that's the $1 million question, I guess. Like, where is the treasury buying going to come from? And some people will point to, stablecoins are this new thing that will save the day because, or hedge funds in the Caymans. But what's your take on who's going to float the treasury market in the near future?
Well, you better hope it's not hedge funds in the Cayman Islands, that's for sure. Because if that's your backstop, oh boy, good luck. Yeah, look, it's the stablecoins. We don't know is a simple answer. Everybody's very certain about everything these days. We don't know what happens. The stablecoins, absolutely. If you look at how they're supposed to work, they could absolutely produce demand for dollars. They absolutely could. They could also introduce great volatility into the dollars by giving people easy means in and out. We don't know, Jay. We know that the stablecoin idea is one that is designed to produce demand for dollars. And at no point in the last 50 years has the United States needed to do that. So there's a sign there. The fact that they're coming up with ways to create demand for treasuries tells you that they don't have all the demand they need. And that's never been a problem before. Look at the size of the deficits. That's never been a problem before. The US has been able to run massive deficits because people needed more dollars, not less. So there's your first sign. The fact that they are actively seeking ways to induce demand for treasuries is a sign, an important one. And we'll see, when the stablecoin when the stablecoins start getting used, we'll see how the dynamics work. But all the time, the vested interests are looking to game whatever system is in place to their own advantage. And so if we end up with a new regime, a stablecoin regime, it won't be that, okay, this is the new regime now and we're all going to play nicely and we're all going to make sure that this works for the United States. No. If the stablecoin comes in, it produces demand for dollars. Other countries will go along with that while they assess how it all works, where its weak spots are, how they can use that system to their own advantage. And I guarantee you that any stablecoin system that's put in place by the US is not going to happen in isolation. They won't be the only country with stablecoins. And it will not be a flawless construct that allows no leakage and shuts off any ways for other countries to take action in their own self-interest that's hurtful to the United States. So again, it's more of an example of the change that's afoot, the different pressures that are being placed upon the United States, and the different incentives, most importantly, perhaps for their trading partners. Before, the incentive was keep the United States sweet, because the United States were not only strong, but they were benevolently strong, and they could be relied upon to be a solid and trustworthy partner that would, in many cases, not necessarily prioritize their own best interests, but they would prioritize the interests of the global order. Those days are definitely gone because the United States can't afford to prioritize the global order anymore. They have to prioritize their own self-interest. And any time you get a benevolent hegemon that switches to a regime where it overtly and explicitly tells you, which Trump has done, America first, you have to reimagine your relationship with that country because they've told you what they're going to do. And it's every man for himself now. So, this change happens slowly, like the Hemingway thing about, how did you go bankrupt 2 ways, gradually at first and then suddenly. These kind of moves happen slowly, and they happen on page 12 of the FT and page 37 of the Wall Street Journal, these little test pilot cases and little stories that get talked about. Back in 2010, Robert Zoellick, who was the head of the World Bank then, talked about a new system with gold at the center of it. This is 2010. And here we are now, 15 years later. There are a lot more people talking about that now. So the system's changing, and it will change gradually, and it will change almost imperceptibly until potentially we get a political opportunity like we saw in 1956, where others, apart from the hegemon, can use the new weaknesses in the system and the designs that have been put in place to try and paper over those weaknesses to their own political and financial advantage. And if America didn't hesitate to throw the UK under the bus, you can guarantee that the Chinese won't hesitate to throw the US under the bus, or anybody else for that matter. We are in a every man for himself environment now. The globalization is dead. It did great things. It outlived its usefulness. And when globalization goes into reverse, we all know what that looks like. And so you better look at the world through a different lens now, which is, how is a given country vulnerable, and whose interest would it be to exploit that vulnerability, and how could they do it? And that's a very different world to the one we've all grown up in, all of us. So we have to completely reimagine the way we think about the world.
We sure do. As you were explaining that, I found myself thinking about some of the conversations I had around the dinner table over Christmas break. My wife and I hosted about 13 different family members, and my family's split American-Canadian. So, and very strong opinions.
You did well to get around the same table, Jay.
It's amazing. And nobody bites their tongue. People say what they think and how they feel. And so there was a lot of spirited debate. And you could guess which direction it went. There's a lot of criticism about the American trade policies. This is aggressive. This is predatory. This is, destructive, all this stuff. But then on the other side, it's like, nah, this is protectionist. We're getting back to what's important. What we had wasn't sustainable. And I can see the debate going back and forth. And paying attention. And what I found myself thinking was, however, like, I need a better answer inside of this debate. And so I began thinking about it, and where I kind of landed, Grant, was that, as you said just now, I think, the world will grow out of any agreement eventually, right? And I've been in business partnerships that were fruitful and equal when they were formed. But 3-4 years down the road, maybe one of us grew faster than the other. Maybe one of us worked harder than the other. And we have to reflect back in the agreement that was fair and say, today, this is no longer equitable, right? And so we have to revisit that. And that's disruptive and that breeds conflict. But the smart thing to do is make the hard decision and have the tough conversation, right? And if you don't do that, you're destined for a world of hurt and pain and resentment. And is that kind of what's happening here? Like, en masse, we could look at all of these organizations that seemingly govern the world order, whether it's the G7. I mean, how many of the G7 countries actually are globally influential today? Is Italy, is France still the way they were when this was formed? Like, do they deserve that respect? And no disrespect, but it's just an honest question. Those economies aren't what they were, 20 years ago. The WTO, same question, right? Does this serve the same purpose? NAFTA, Trump's taken aim at Canada and Mexico. Is NAFTA still relevant today? Is it still important and useful? And you could interpret this as aggression and whatever you want. But in the end of the day, it's like the world's changed and the agreements are dated. They have to be updated. No one likes that, especially if you're, a country that used to be important and used to have influence. And maybe you don't have that on the balance sheet anymore, but you want to hang on to that. You're not going to go down easily. You're going to go down swinging and clinging to power, as anybody would, I suppose. Yeah. But what's your take on that?
Well, look, let's throw in the United Nations, the World Bank, the IMF, all of them created at the end of World War II as part of the Bretton Woods Agreement, essentially. It would be a challenge to argue that they're all still fit for purpose, that they're all still as important as they were, and they all still do the kind of job they were designed to do in this new world. So you're right. I mean, all of these institutions, every single one of them, is at a point in time where it needs to prove that it's fit for purpose for this new world we've just talked about. And a lot of them aren't, And it's interesting, Jay, when you talked about the two sides of that argument around the table, of course, the reality is they're both correct. The question is one of motivation. Is it imperative that America undergoes this change in policy to rebuild itself? Absolutely. Is it predatory? Absolutely. But it's predatory because they have to do it. They need to do it. And when they need to, they don't have a choice. So, if they didn't need to do it, they could perhaps say, well, you know what, we don't want to do this. It's predatory. And that's the way the world has functioned. But United States needs to do that now. It needs to reshore. It needs to rebuild its manufacturing capacity in a more hostile, less cooperational world. And so it doesn't have the luxury of choosing whether to be predatory or not. So everybody's right. Yes, it's all of those things, but why? And that's the important thing to understand is why. Why is the US doing what it needs to do and being predatory? Because it has to. And anytime you have to do something, you're in a position of weakness. And that's just the reality of it. So I think the point you make is an important one. It's it's a classic sign of the fourth turning. If anyone has read that book, they'll understand that all these institutions being torn down and reimagined and rebuilt. And if you haven't read the fourth turning, I would highly recommend it. I'm sure you've recommended it as many times as I have, Jay. The book, the original book by Neil Howe and Bill Strauss, was written in the mid '90s, and it predicted the financial crisis in 2008 and just about everything that's followed. It's an important book to read, but this is all part of that. This is all part of that change, and it's really uncomfortable for us. I think that's the other important thing for us to recognize is that for human beings, periods of change like this, real change, not seasonal change, but epochal change, are really, really uncomfortable places to be. And we've lived our entire lives in this really comfortable upswing post-World War II. Our parents lived through World War II. Their parents lived through the Great Depression. So they saw the kind of upheaval that we haven't been privy to. But now we're getting our upheaval, and it's not nice. And we're not having to go through a depression yet. And we're not having to go through a world war yet. Who knows? Either of those things could happen. I'm not predicting them, but either of them could happen. But you're to be part of a generation that manages to live its entire lifespan without any real hardship, as we've done this last 50, 60 years, is amazing. But it's not the norm. It's absolutely an aberration from the norm. So we need to, again, understand that and realize that just because we don't like change and we don't like how it feels for all these things to be changed on us, again, we don't have a choice. The change is happening, and it's how we adapt to it that's most important.
Yes, absolutely. And, I think about this a lot with, I got 3 young kids and I got a 4th on the way. And so I got a...
Oh, congrats, man.
Thanks, buddy. April.
Terrific.
First baby girl. We got one. Four times.
Fabulous.
Yeah. But I find myself thinking about what are the next 20, 30 years going to look like, right? Where should we be located, right? What should our lives be? How should we build our lives, right? We have the optionality of being in Canada and the US. We've spent about half our time in the last few years in Indonesia, just exploring the concept of putting down roots there, right? I like Southeast Asia. I like a lot about it. But more importantly, it's easy when you have a conversation like this or listen to one, global shift is happening. Often these fourth turnings result in hot global conflicts. They result in wars. They can be scary times. A lot of institutions you believed in might be destroyed. A lot of change, a lot of uncertainty. That all sounds bad. It's important to step back and look at the longest term or any long-term trajectory of human ingenuity and progress. And you'll see it always goes up and to the right over a long enough time period. I'm long human ingenuity and progress all day long. And we go through these changes and it's what do you do, right? Well, I think for us, it's a time of simplicity. Be very conscious of debt and just be very responsible with the personal balance sheet, but also just get up and work hard. And if the world crashed tomorrow, what would I do differently? Nothing. I'd get up and hustle tomorrow morning, right? I would go to work and try to build something and create something and nothing would change in that regard. So it's easy to get sucked down the rabbit hole of doom and gloom and prepper, which isn't necessary because I think the future's bright. But in the meantime, how do you manage your emotional state when all this chaos is, landsliding onto your desk in the form of headlines?
Right.
And I think it's just keep it simple, right? Go to work, keep it simple. How do you do that?
Yeah, I mean, it's a decision and a choice that we all make, right? I mean, this is why the whole issue of this kind of wave of financial nihilism, as Dimitri Kofinas so beautifully coined it, is so saddening. Is that the people are not doing what you're saying; they're going the other way. Instead of getting up and saying, "Right, I need to go and hustle," they're "There's no point in me hustling. I'm gonna YOLO on an NFT. Right. I'm gonna just swing the bat big because I need to make as much money as I can, as quickly as I can, with as much risk as I can. And if it all goes wrong, it all goes wrong." And that's, again, but all these are signs not just of change, Jay, but of complete reversal of the mindset, because you and I have grown up with that mindset. The thought of getting up and hustling or not getting up and hustling doesn't occur to us. But this change that's happening that we're talking about has created that mindset amongst a group of disenfranchised people for completely understandable reasons. I mean, it's heartbreaking. But it's all part of this same change. It's all part of this reversal of the tide that lifted all boats. And, you talk about progress being up and to the right. You think about the depths of World War II and how terrible that was to be caught up in. And then you look at what happened in Europe and the US and Asia in the 50s and 60s after we came out of the war. Extraordinary growth, extraordinary prospects, extraordinary change. And that will happen again. It's just that there's a piece between here and there that is going to be uncomfortable for a lot of people. And our job is to, as you quite rightly say, when you've got kids, you think about that. Okay, how do I navigate this? Not just for me, but how do I navigate this best for my kids? How do I make sure that I'm in a position to provide whatever they might need, because they're the ones who are going to be in the midst of this crisis during their earning years, during their house buying years, during all the things that we were fortunate enough to be able to go through. And I'm not quite a boomer. You're definitely not a boomer. But we weren't as lucky as the boomers, but we were fortunate enough that we were able to work and build wealth and buy a house and raise a family. And at the moment, those traditional objectives seem out of reach for a lot of people, which is an absolute catastrophe. Mm-hmm. But this change, in some way, will rectify that. If you think about what needs to happen, is either everybody has to find some way of earning a lot more money, or house prices have to get cut by 60, 70%. And we all know which is the easiest one of those routes, right? It's for there to be a housing crisis and for houses to become affordable again. And once houses become affordable again, you can dream. The financial nihilism goes away. You can think about buying a house. You can think about raising a family. And it's all part of this rebalancing. And that's where the positive stuff comes from. You go through the upheaval, you go through the change that feels so painful in the moment, but it releases an entire generation of people who have been unable to plan the kind of future that we took for granted a generation ago. So, it's not easy. It's really difficult, in fact, and it's confronting, it's challenging, it's emotionally draining, it's all of those things. But we have no choice but to try and navigate it the best way we can, knowing that on the other side of it lies opportunity for a whole generation of people. And we've just got to navigate the here to there somehow.
I love that. And, your question about how do you manage it, and I think often about what's at the core of so much of the civil divisions and unrest and people's despair around, like, the house I couldn't afford last year is somehow less affordable this year. How did that happen? And a lot of that is because people are never taught the language of money. You can go to 13 years of public school education, then go get a 4-year bachelor degree and come out having never heard the term credit or what a capital gain is, having never been explained what leverage is, any of this stuff. And so there's therefore this mystery around why things seem a lot harder than they used to. And since you don't know why, they seem a lot more complex and harder. Whereas you understood some of these principles, you might see opportunities that you wouldn't elsewhere. And so therefore, what you're going to do, I've got advice now for everybody. Here's your marching orders. If you enjoyed this podcast, your first step is you're going to go to grant-williams.com and you're going to sign up for Things That Make You Go, a monthly newsletter that Grant publishes. I never miss it, ever. It's amazing. Grant usually opens the letter with about a 20-page article that he's written about something important. And December's issue I thought was fantastic. I know there's a part 2 coming out in January. And then you always highlight, 15, 20 articles that you think are worth reading. Start there. Then you're going to go to thecommodityuniversity.com and sign up and join a crew of investors who are building a competitive edge, becoming mining investors. So we're looking at the mining equities market, the gold producers, silver, copper producers, and deciding how can we participate in this commodities boom. But we're doing it as a community because the mining sector is really, really hard. It's super risky and very easy to get cleaned out. So don't go it alone. Join a club, join a community, share ideas. We have chat groups every day. I'm sharing what I'm doing. People are sharing what they're doing. It's a great way to learn from peers. Hyper important. Next, you're going to go to vricmedia.com. Come to Vancouver in January, January 25th, 26th, the Vancouver Resource Investment Conference, 2 days, jam-packed. Insight from investors. We fly in from all over the world, 6 stages, around 9,000 investors expected this year. And this is the true Super Bowl of the junior mining sector. And your last stop is superterrifichappyday.com for Grant's conference. February 17th in Miami. I'm going to be there. I'm really pumped to be there because I missed it last year, but I won't miss it this year. So I'm looking forward to that. And Grant, thanks so much for your time today. It's always a blast chatting with you.
Jay, it's my great pleasure. I will just quickly correct you. It's Tampa, not Miami. It's Florida, but we're on the other coast,
isn't it? That's right.
Yeah, St. Pete.
Yes.
And I would just echo. Unfortunately, I can't be at the VRIC this year I've got some personal conflicts that stopped me coming, which is a real shame because it's one of my favorite weeks of the year. But for everybody listening, if you haven't been, it's an extraordinary event. And if you are interested in resources, not only is everybody you need to meet and see there, but every company you need to meet and see, that everything's there. So it's a terrific place to go. So I wish you luck with it, Jay. I'm sorry I can't be there this year. Hopefully I'll get the invite next year and I can come back again because it's one of my favorite weeks of the year. So best of luck with it.
I appreciate that. 100%. It's an open door. All right, Grant, thanks so much for your time today, man.
Anytime, mate. I'll see you soon.